Welcome back. In my last session, I talked about one of the rituals I go through at the start of every year, where I invite people to come along on my teaching journey, to sit in my classes virtually and take my classes. In this session, I want to talk about another one of the start of the year rituals I go through. It's where I update data and I welcome people to take advantage, to use my data if they find it useful. In this session, I want to talk about three things. One is I want to provide a motivation for why I update the data, why I do it, and why I share the data. Second, I want to talk about the data sample that I use, the companies that go into my data. And third, I want to talk about the data variables that I estimate and report on my website. Now, before I do any of that, let's be quite clear. The game has changed on data. When I first started valuing companies, and this is a reflection of my age, data was scarce. To value a company, I had to get an annual report, a physical annual report. Numbers like industry averages were really difficult to get. You were dependent on a service like Value Line or S&P for an industry average, because to do it yourself, to hand collect the data for companies and estimate the average yourself. How things have changed. We live in a world where data is abundant. When people tell me that they don't have enough data, now, it's a relative statement. We have a problem of too much data rather than too little. And in my view, it's creating some unhealthy side effects. The first is creating distractions. As you look at data, there's so much data pulling at you in different directions that it's easy to get distracted and chase the data down, which is really not that critical to your analysis. It's immaterial or a small number, but you still feel the urge to chase it down. There are distractions. The second is, for some people, data has become a crutch. Rather than estimate a number or reason your way to an answer, people think that the data is already out there, that they will get an answer from the data. This, to me, is the greatest weakness of the big data argument, the argument that the data will tell you what to do. And third, there is this notion that data is objective, that estimates are subjective. That couldn't be further from the truth. I've seen people use data to advance biased judgments. It's easy to be selective about the data you use. In fact, when people use anecdotal evidence, they are using data selectively. I think there's a much healthier way, a much healthier relationship we can have with data. And there are four things that you can get out of using data well. And this is why I update the data that I do. It's to help myself. First, it gives me perspective. It gives me a sense of what companies are doing. What does profitability look like across companies? You're saying, why do you need to do that? Without it, how do I make judgments on individual companies, value them, do analysis? If I don't know how profitable a typical software company is, I cannot value an individual software company. So the first advantage of looking at data is it gives you perspective. What's high, what's low, what's average? The second is, while I'm not a knee-jerk believer in mean reversion, that things always revert back to averages, let's face it, it is a strong force and it's dangerous to ignore it. When you value a company with a really high margin relative to the sector it's in, you can expect the margin to move down over time, perhaps not down to the sector average, but towards it. But to do that, you need to know what the sector average is. To do any kind of investing or analysis, using data to get a sense of what you want to move your numbers towards is critical. The third is, and don't take me the wrong way, but people seem to make up stuff. Have you noticed experts, politicians, market gurus, analysts, they make up stuff. They make claims, and if you don't know better, you go along with their claims. For instance, last year, there were a few people, and I won't name names, who claimed that inflation was here because companies were charging higher prices and becoming more profitable. Well, that's something you can test with the data. Or you've heard the assertion that US companies pay far less in taxes than companies incorporated elsewhere. Might be true, but until you look at the data, how do you know? I found that data is the best anecdote or the antidote to people making up stuff. It's the antidote to bullshit. And fourth, we're surrounded by rules of thumb. These rules of thumb are often decades in existence. They've been around for so long that people believe they're true. I'll give you a few examples. A stock that trades at less than book value is cheap. Really? Says who? I've heard private equity investors tell me that a stock that trades at an enterprise value less than 6 times EBITDA is cheap. A company that has a debt ratio less than 30% is cheap. I don't know who makes up these rules of thumb, but the only way to check whether the rule of thumb actually makes sense is look at the data. So I look at the data to cleanse my mind, to get a clear sense of what the numbers are telling me. I have also discovered that to do valuation in corporate finance, I need to have access to industry averages, to that data. And rather than do it each time I do an analysis or valuation, I think it saves time to do it up front at the start of the year and use it for the rest of the year. In other words, software company margins are not going to change dramatically between January and June, so might as well do once. Now, cutting a long story short, I update the data because I need it. I use it on a daily basis for the rest of the year. But early on, I started thinking about, hey, why shouldn't I share the data? What do I lose by sharing the data? And I couldn't think of a single thing that I lose. I couldn't think of a single good reason why I shouldn't share the data. I'm not a Mother Teresa. I don't share the data because I'm altruistic. I share the data because it costs me absolutely nothing. So as you use these numbers, recognize that they're computed and created for a very selfish reason, for me. And if you happen to find them useful, well, that's great too. So with that lead in, let's talk a little bit about my data updates. And I'll start with a little history. My first data update, I think, was in the 1990s. I forget the year. I updated about 10 different spreadsheets, and I allowed people to have access to those spreadsheets. I didn't expect very many people to take advantage of the data update. Over time, it's grown, and perhaps it's my ego making it grow. But in this year's update, I have probably 300 data sets and 1,000 variables you can update, you can download and use in your analysis. Now, I have no qualms, as I said, about you using the data, but I think you will find the data more useful if you understand how it's computed, where it's coming from, what my universe looks like, and why I compute the items that I do. So let me start by describing my data universe. When I started thinking about computing numbers like industry averages, I wanted to make sure that I did not create bias by looking at a subset of companies. I'll give you an example. I could look at industry averages by looking at just the S&P 500 companies. The problem is it's US-centric and large companies. I cannot use those averages if I'm looking at a small Indian company or a medium-sized Brazilian company. So here's what my sample looks like. It includes every publicly traded stock listed in any market of the world with a market cap greater than 0. So it's pretty much every publicly traded company. To give you a sense of the geographical breakdown, I have the total samples broken down both in terms of numbers of firms and in terms of market cap. If you look at the numbers of firms, for my 2023 update, there were 47,913 firms in my sample. The largest single group was the US, but you can see, the largest single group was Small Asia. Small Asia is basically Asia not including India and China. So 9,591 firms, followed by the US, followed by, and you can see the markets that I focus on. China, I think, is the third largest. China and the US are the second and third largest markets. That's in terms of numbers of firms. I also look at the market cap of these firms, and in that dimension, US firms are still more than 40% of the market. About 41.5% of the market is comprised of US firms at the start of 2023. So my sample is global. It includes small firms and large firms. It includes some of the most liquid markets in the world and some of the least liquid markets in the world. But my objective here is to look across all publicly traded firms. There is a bias though. You know what the firms I'm ignoring? For every publicly traded firms, there are probably 100 privately owned businesses. I don't have them in my sample, not because I don't want to include them, but because they don't have to publicly share the data. The data is not there to be able to do this with privately owned companies. So keep that in mind. This is the numbers you're going to see are statistics coming across all publicly traded companies, small and large, across all parts of the world. Now, I do break these companies down because if I just gave you the numbers across all 47,913 companies, what are you going to do with it? So I break these companies down not just geographically, but by sector, and I use the S&P sectors, widely tracked, as well as by industry grouping. The sector groupings, if you break them down, you get a representation across sectors. I think technology is the single largest sector in the world, 21% of the overall market cap, but the companies are across all sectors. I break the sectors down into 95 industry groupings, and this is a concoction, a creation of my own. Now, so as you look at these industry groupings, I'm sure you're going to look at them and say, you know what, I'd have used a different grouping. You're right. There are other groupings, and I use these groupings partly to create continuity in my data. What do I mean by that? Remember I said I've updated this data since 1996. I've stayed with roughly the same industry groupings over that 26-year time period, which means you can compare the companies within a grouping across years on my particular database. Now, in terms of macro data, I don't report much in terms of data items. I don't report much in terms of macro data, partly because they're a much better source of macro data. My favorite is, of course, the Federal Reserve Economic Database, FRED. And if you get a chance, you should visit it because it contains, while it has a U.S. bias, it has data for the rest of for global data items as well. But it includes incredibly rich data on pretty much any macroeconomic variable, whether it's real economy, inflation, interest rates. I do report on a few market-wide items, but I do it because I need it. Things like equity risk premiums. Why? Because I need it in valuation. Default spreads, because I need it for the cost of capital. So there'll be relatively few market-wide data items. Most of the data that I report is at the company level. Now, I don't want to list out individual company data items because there'd be too many. But broadly speaking, this table lists out all of the different variables you'll be able to find broken down by industry grouping as well as by region of the world. I report this data. So across 95 industries, I report the betas by industry, the standard deviation in stock prices, risk measures. I report cost of equity, debt, and capital by industry. I report pricing multiples, PE ratios, price to book ratios, enterprise value multiples, revenue multiples, profitability numbers, net profit margin, gross margin, you name the margin, I report on it by industry grouping. I also report measures on debt ratios, debt to capital, book and market, debt to EBITDA, interest coverage ratios. I also report on reinvestment numbers, basically how much do companies put back into capital expenditures, acquisitions, non-cash working capital. I report accounting returns, which are widely used, and I use them with a fair degree of skepticism. Return on equity, return on invested capital, excess returns, where I compare accounting returns to cost of equity and capital. I report on measures of how much companies return in dividends and buybacks and dividend yield, again broken down by industry grouping. As I said, the only market-wide data I report is risk premiums. I report historical returns on U.S. stocks, U.S. bonds, and other asset classes. I also report implied equity risk premiums for the U.S. If you have no idea what I'm talking about, I would suggest you look at my definition of implied equity risk premium, how I compute it. I also report equity risk premiums by country because the companies I value often have operations in different parts of the world, and bond default spreads. For growth rates, I look at historical growth rates in earnings and revenues as well as expected growth rates. I also report what I call sustainable growth rates that companies can maintain if they keep their current return on capital and current reinvestment policy. I do some cleaning up after accountants. I've always treated leases as debt. Accountants now do the same, but I've always treated leases as debt well before accountants came to that recognition, and I look at the effects of reclassifying leases as debt on profitability numbers and balance sheets. I do the same thing with R&D, an operating expense that should really be a capex. I treat it as a capex and trace out the effects across companies. Finally, I report on both marginal tax rates by country and effective tax rates. So if you get a chance, if you visit my website and you look under data, especially under current data, you should be able to find links to each of these items and more. In addition, I report on each of these data items, not just by industry grouping, but by regions. And I break the world down into 5 regions: US, Europe, Japan, Australia, New Zealand, and Canada, and emerging markets. Emerging markets is the largest of the mix because it includes much of Asia, Latin America. And then I also report for India and China individually as countries. Finally, I reported global averages for all of those. So there are 8 different regional breakdowns / global breakdowns of each of these variables. Now, in terms of timing, a little measurement issue comes into mind. I do much of this analysis in the first week of the year. Now, if you think about the numbers that I have available in the first week of 2023, for market numbers, the numbers are as of the first week of 2023, interest rates, equity risk premiums, so I use current numbers, market capitalizations. For accounting numbers, I'm in a bit of a bind because companies don't update their accounting statements on January 1st, so they don't do the December year end on January 1st. In fact, for income statement data, what I call flow accounting items and income statements and statements of cash flows, I use the last 12-month data, which for most companies is from October 1st of 2021 to September 30th of 2022. And it says October 2022 to September 2023. It's October 2021 to September 2022. For stock items from balance sheets, I report the numbers from the most recent balance sheet, the cash balance. I don't average things because I don't believe averaging delivers anything of value. Now, for some of you, this might sound inconsistent that my market cap numbers are as of January 1st, but my income is as of September 30th. I don't think it's inconsistent. In fact, my definition of consistency is, am I using the most updated information that decision makers, CFOs, investors, individuals would have as of January 1st, 2023? And my answer is yes, I am. So with that background, feel free to use whatever data that you find on my website in your valuations. If you want to give me credit, fine. If you don't want to give me credit, that's okay too. If you get into trouble using my data, blame me. But I have a few caveats I'd like to offer. First, now for those of you who write to me asking whether my team can do this or my team can do that, recognize I'm a team of one, that I pretty much do everything. I'm a control freak. I can't help it. So and I make mistakes. Why? Because when you have an Excel spreadsheet that runs 47,913 lines and 300 columns, you sometimes screw up. And I'm sure I've screwed up. And if you find a mistake, let me know and I'll fix it as soon as I can. I know there are judgment calls I've made about where to put a company, and if you don't like it, I'm sorry, but I had to make the judgment. I do get pushback on geographies. You'd be surprised at how many people get upset at me that I put Mexico in Latin America rather than North America. In terms of geography, you're absolutely right. It is North America, but I think it fits in better with the rest of Latin America. East Europeans take issue with me because they claim they should be part of the Western European group that I include. Again, I'm not making any kind of judgment here. I'm just doing it partly to preserve consistency across time, and partly because I have to stay with some kind of definition, and whatever I do, people are going to take issue with me. On the company level data, I do not provide company level data. So if you want to see the latest income numbers for Apple, you won't find it on my website because you can find it yourself. It's easy to find now. And in fact, if I know most of you don't have the money to afford a Bloomberg terminal or S&P Capital IQ, but there are quite a few online services now, and I will list out a few at the end of this session that you can try out, which are very reasonably priced that you can use to get company level data. As far as agenda, everybody's an agenda. I don't think I do when I create my data updates, but I'm sure there's some slippage there. But I know there are people who use my data to advance a point of view. I've seen my tax rate data used by people who claim that US companies don't pay enough in taxes, as well as by people who claim they pay too much in taxes. They just pick a different definition of tax rates off my webpage. If you use my data to advance a point of view, I'm okay with that, as long as you don't claim that it's my point of view. You're very clear that it's your point of view. If you're in a fight with a colleague, legal fight, an online fight, why do you get into online fights? Are you crazy? But if you are, and you're using my data as ammunition, then keep me out of it. I don't want to be part of your fight, and I hate courtroom battles. I've tried very hard never to enter the legal arena with my data. This data is meant for real-time analysis, not for legal fights. But if you use it, take ownership of it. Finally, I did my update. It's done. It's January 6th of 2023. I will not do another update till the first 5 days of next year. And the data will get stale over the course of the year. The industry averages on things like profit margins and risk, I feel no qualms about using the data for the rest of the year because it's not going to change that much. The margins are not going to dramatically shift during the course of the year. But on pricing metrics, PE ratios, EV to EBITDA, if the market moves up or down strongly, then those metrics will very quickly become outdated. So as you get later in the year, if you're using a pricing metric off my side, be careful about it. Overall, though, I don't attach any rules to my data. There's nothing you need to draw attention to. Feel free to use the data, as I said, I'm not doing this for altruistic reasons. You don't have to thank me. And if you feel the urge to do something for me, my advice, my suggestion that the best thing you can do for me is find somebody else around you who needs help in terms of understanding something, getting data, and pass it on. Because I think that, a little bit of that can make the world a better place. Finally, I do want to set the stage at least for my plans on what I plan to do with the data, because I haven't talked about any of the numbers that I've seen this year, and that I hope to remedy in the weeks to come. It was the year of inflation. Inflation was center stage and it affected everything. So in my next 3 posts, I'm going to start in post 2 by looking at equities, how inflation played out in equity markets. Second, in post 3, I want to look at bond markets, government bond markets, corporate bond markets. In post 4, I want to look at other asset classes, gold, collectibles, crypto, how inflation played out there. In my 5th post, I want to look at how country risk made a return in 2022. For those people who thought it's gone, you don't have to worry about it anymore. Russia's invasion of Ukraine changed all of those dynamics. So I want to talk about country risk and how it's changed over the course of the last year in post 5. In 6, 7, and 8, in post 6, 7, and 8, I want to look at corporate finance basics, how costs of equity and capital for companies have shifted during 22, and they've shifted a lot. How, as interest rates climb, companies are starting to think about how much debt they have, which sectors have the biggest debt, what the worries look like, and how much companies are returning in dividends and buybacks in my 8th post. In my 9th post, I want to look at market pricing, because 2022 was a year of repricing, with technology taking the biggest hit among sectors and value coming back on top over growth. So I want to look at how pricing has shifted across the market and across the corporate life cycle. I know that along the way I'll probably get distracted. I have to fit an evaluation of Tesla somewhere in there. It's time. I also want to revisit my FANGAM, Facebook, Amazon, Netflix, Google, Apple, and Microsoft valuations sometime in February. But over the next 2 months, keep your eyes open if you're interested, and these 9 posts should show up. I hope you found the session useful, and I hope you find my data accessible and useful in whatever you do. Thank you very much for listening, and take care.